Some numbers in finance are too large, too ungraspable to comprehend. But what about time? How can an investor get to grips with a 70-year span, the amount of time before Austrian government bonds sold on Tuesday will have to be repaid? For instance, buy a bond for a child born in Vienna today and they might have perhaps a decade to spend the cash when it matures in November 2086, based on current assessments of life expectancy. Only their as yet unborn children might encounter the event professionally, if humans are still needed to oversee the computers of finance then. Look backwards for a sense of scale, and 70 years ago this week, the world got its first glimpse of the planet from space. American scientists using a Nazi V-2 ballistic missile to snap pictures from the void. Modern, independent Austria, well, that was not to emerge from Allied occupation for almost another decade. Yet such ultra-long bonds are becoming, if not popular, increasingly common. The 14 billion euros worth sold this year by France, Belgium, Spain and Italy, well, that's more than had been sold in the previous decade, since France launched the first 50-year euro deal back in 2005. One reason is they are not really long-term investments for people, but rather a way for institutions to bet on what happens to inflation. As small movements in interest rates have a big effect on the value of these ultra-long bonds, they will be much more valuable if deflation again appears to be a danger. Realise, however, that computers are in some sense already telling humans what to do. To buy these bonds because they fit into a particular model for what the liabilities of insurers or pension funds will look like many decades ahead. And if governments can get away with selling debt which makes little sense to mere mortals, well, they should do as much of it while they can. Time waits for no man, after all.